Bien, pues muy buenos días a todos y bienvenidos a la presentación del World Energy Investment Report 2025 que ha publicado la Agencia Internacional de la Energía en el pasado mes de junio. Quería dar las gracias a todos los que os habéis conectado y a los que habéis venido aquí también. Como sabéis, desde el club tenemos el privilegio de poder presentar los informes de la Agencia Internacional de la Energía. Solamente en el último semestre del año hemos presentado el informe de gas, el de vehículo eléctrico, el de energía eléctrica y el de nuclear. Y como comentaba, hoy le toca el turno al World Energy Investment Report. Contamos con 4 ponentes que van a analizar su presentación, que han participado en la redacción del documento y lo van a hacer desde París y en inglés. Y por tanto vamos a cambiar al inglés. So today we have the pleasure of having 4 speakers from the International Energy Agency who will be presenting the World Energy Investment for 2025. I think it's its 10th edition, if I'm not mistaken. So first thing I would like to do is to introduce the 4 speakers from the agency. So we have James Bragg, Energy Analyst, Haneul Kim, Energy Investment Analyst, Lorenzo Albertini, Energy Investment Analyst, and then for the Q&A questions, we will have Tanguy, the Bienassis, lead of the World Energy Investment 2025. So thank you very much to all 4 of you for being with us today. It's a real pleasure to have you presenting this report, which is available in the agency's website. And this report provides a full update on the investment picture in 2024 and also an emerging picture for 2025 across all areas, so fuel and electricity supply, critical minerals, efficiency, research and development, and energy finance, and also for different geographical areas. So this year's edition also reflects on energy investment trends over the last decade. Just a few spoilers, just 3 messages that have come out from the report. So investment in clean technologies, renewables, nuclear grids, storage, low-emission fuels, efficiency and electrification is on course to hit a record of $2.2 trillion this year. Investment in oil, natural gas and coal is set to reach $1.1 trillion. And also China is by far the largest energy investor globally, spending twice as much on energy than the European Union, and almost as much as the European Union and the United States altogether. I would like to say that this report also has an interactive data explorer that enables users to compare energy investments across multiple sectors, fuels, and technologies between the period 2016-2020 and 2021-2025. So concerning the dynamics of the session, what we're going to do is after your presentation, we will have a Q&A session. Padilla is here also, and she will be collecting all the Q&As from the Zoom, and you can address your questions through the Q&A button there. So that's it from my side. I would like to give the floor to the speakers so they can start with the presentation. Thank you very much.
Thank you very much, Pablo. And while we share the presentation, let me say a couple of words, although you've already covered the sort of main objective of the World Energy Investment Report, just about us. So we all work in the investment team of the International Energy Agency, and we are part of the broader team that works on the World Energy Outlook. And so the World Energy Investment is sort of a special report of the World Energy Outlook. And as you said, what we're trying to do here is to estimate the total spending that goes into the energy sector, the entirety of the energy sector, from fossil fuels, clean energy, energy demand, and we try to be as comprehensive as possible in our estimation of the annual investment that goes towards the energy sector. So I'm not going to speak for long. I'm going to pass the floor to my colleagues who all worked on several parts of the report and who will take you through the presentation. I think we have about 30 or 40 minutes presentation, 45 minutes presentation, and then we'll be happy to take questions. Don't hesitate to post questions as we go along in the presentation. We'll come back to them at the end, and we'll be happy to answer all of them. And with this, I think I'm passing the floor to Lorenzo.
Thank you, Tanguy. Thank you for the introduction. So we can start with the big picture of investment flows that have characterized the last 10 years. After the lower peak in 2020 of energy investment, we have seen an increase of energy investment during the last 5 years, with the highest peak in 2025 according to our expectations, reaching 3.3 trillion in energy investment. How is this increase related to the different technologies? We know that the fossil fuels didn't play an important role in this increase. Actually, after the low values of during the COVID pandemic, the investment in fossil fuel have reached values of 2016 and 2019. So we want to highlight that actually the increase of the previous year in the total energy investment is due to a small part related to low emissions fuels, a big part related to renewable power, that is the main factor, with an increase of 80% from 2020. And again, going on, we have a small influence of nuclear energy investment, grids and storage, and finally, we have seen an higher expenditure from households, so in energy efficiency and then use electrification, including a sharp rise of EV sales. But if we go on and we take a look to regional level, this is the picture that we saw in 2015, with China surpassing United States, but still they were kind of close in terms of total energy investment. What happened in the last 10 years? In the last 10 years, we can see, first of all, the huge increase of China's energy investment, almost 3,050 billion per year increase. Also, we can see a great increase in United States, European Union, and India energy investment. And what is actually very important to highlight is African continent. African continent has experienced a decrease of more than 30% in energy investment, especially due to a cut in expenditure in oil and natural gas. Now, this is also shocking because Africa is accounting also for 20% of the global population. Going a bit deeper into the technology distinctions, we can see that fossil fuel plays an important role, but still China, even if it's investing in coal and fossil fuel, it's dominant in the renewable power investment. Another topic that we wanted to highlight actually was the energy securities. Always taking into account the last 10 years, we split this period between 2015, the year of the signature of the Paris Agreement, and 2021, the year of Russia's invasion of Ukraine-Russian invasions. And we wanted to check, according to selected countries and selected regions, what has been happening in this country in terms of investment. And if we take a look to the last 3 years, we can see that energy security is not just investing in fossil fuel and natural gas, but it also has an important role related to renewable power, grids and storage, and nuclear. Taking a look to the specific regional, the selected regions, we can see that Japan and Korea are the only one in which there was a decrease in the last 3 years in investment related to oil, natural gas, and coal, while for all the others, there was a peak of increase in energy investment in these fossil fuels. However, energy security stands, the strong focus on energy security is especially a much larger increase in clean energy investment. Again, let me repeat, renewable power and grid and storage. If we go on the next slide, we can see that we go back to the oil investment and what has been happening in the last 6 years. At the beginning of the year, the companies published their investment planning and industrial capital expenditure plans. And typically what we were expecting at the beginning of the year, it was a similar year related as 2024. However, more recently, demand expectations revised down, and there was more OPEC plus supply coming back to the market, and oil prices have come under pressure. This has led many companies to revise their investment plans, impacting for a decrease of 6% in upstream oil investment. Now, let's try to take a look and to understand why there was this decrease. Some of the largest decrease have been seen in US tight oil in the United States, where the drop in oil prices is challenging profitability. Moreover, there was also reductions in investment into new and existing fields. Especially this last category is very important, as it could suggest that production from these fields might see slightly accelerated declines. However, let us highlight that a decrease in investment doesn't necessarily mean a decrease in production. Indeed, for example, in the US shale patch, a recent wave of mergers and acquisition and continued technology improvements have continued to pull down the costs. This means that the production is still get to grow in 2025 despite the fall in investment. For what we can say related to natural gas and especially LNG, we expect upstream gas investment to grow this year, and spending of a new LNG facilities is on a strong upward trajectory as new projects in United States, Qatar, and Canada and elsewhere prepare to come online. Now, let's take a look to low emission fossil fuels. So investment in low emission fossil fuels have strongly increased in the last 10 years. However, less than $25 billion, remaining a small part in absolute terms. Hydrogen investment has been growing quickly in the recent years, but IEA analysis in the Global Hydrogen Review has highlighted how difficult it has been for supply projects to move to FID, and there have been some project cancellation or delays in the past 12 months. The common denominator across all these investments has been their high dependency on supportive policies. Indeed, we can see that China, United States, and Europe created a favorable environment for such an investment through mandates, quotas, and subsidies. Over the past year, we have seen additional policies coming into place. One of the main examples in the last period is Brazil enacted the Fuel of Future law, and also the International Maritime Organization developed an important framework for the shift to lower emissions maritime fuels. Now I will leave the floor to James to introduce you the age of electricity.
Perfect. Thank you, Lorenzo. Hi, everyone. My name is James Bragg. I'm an Energía investment analyst. And I was the author of the power sector of this year's World Energy Investment. And so I'm going to take the next 10-15 minutes to talk through the power sector, sticking to this theme of the age of electrification. While we were writing this report, we did see a market increase in uncertainty. Macroeconomic conditions changed quite dramatically upon the tariff announcements. And so while we were doing the modeling for this report, there was some concerns or some questions as to whether this might actually act as a drag on investment in the power sector. But the more that we looked into this, and indeed the more that we spoke with various members of the financial community, the more we came to the conclusion that, in fact, the investment case for the power sector remains incredibly strong in 2025. So we really do think that the age of electrification is not something that's happening in the future. It's really already here. And perhaps this is most clear when we look at investment into the power system over the past decade. And so on the screen right now, you're just looking at power generation investment. In 2015, it was around $600 billion. Since then, global electricity demand has increased by about 30%. And for the first time, we are expecting investment in just generation alone in 2025 to surpass $1 trillion. So what has been driving this dynamism? There are certain technologies for which investment over the past decade has remained relatively flat. That would include hydropower, as well as thermal generation from natural gas and coal. Although in a later slide, I will return back to the topic of coal because there's some important caveats here. Nuclear has seen quite substantial growth in investment of about 50% since 2015. That has mainly been driven by new construction starts in China, as well as rising costs and lifetime extensions in advanced economies. But really, perhaps no surprise then that the biggest drivers of this massive increase in investment over the past decade can be attributable to solar and wind. Solar in particular has seen quite remarkable growth. In 2025, or compared to 2015, we were looking at annual investment growth of over 200%. And today, investment in solar PV is nearly as much as we invest in all of the other technologies combined. Wind as well has seen quite impressive investment growth on an annual basis. It's increased by 70% since 2015. Although we do note that there has been some recent setbacks, some rising costs, which are inflating some of these investment values in recent years. However, if we turn to a different part of the power system, a slightly more worrying narrative emerges, and that is the story of grids. Grid investment has not kept pace with the massive increase in generation investment that we've seen over the past decade, nor has it even grown as much as electricity demand over the same period. For example, I think in 2015, for every dollar invested in new generation, about 60 cents was spent on grids. Today, that value has decreased to about 40 cents per dollar. Battery storage has been really quite a remarkable success story. That market or investment in battery storage was less than $1 billion in 2015. In 2025, we're expecting that to surpass $60 billion. And to put that into perspective, that's nearly as much, or we're quite quickly approaching global annual investment into unabated natural gas generation. So we see that investment in battery storage has helped to compensate for an underinvestment in grids, at least in some regions. However, we do think that this sort of growing disparity between investment in generation and batteries on the one hand, and grids on the other is unsustainable. And we can clearly see now in some regions that underinvestment in grids, of course, is acting as a bottleneck to reacceleration of deployment of solar and wind. And of course, as well too, as solar and wind become an increasing share of the generation mix, underinvestment in grids could also lead to or have some implications for energy security and system strength and reliability. But I'm just going to talk about the big picture for electrification here. If we were to sum up total investment in the supply of electricity, so generation and grids and battery storage, and we include into the picture the electrification of end use, which my colleague Haneul will speak to in a few slides from now. If we sum up all of that, we find that actually in 2025, investment into electrification now accounts for over 50% of all energy investment globally. And so this is why we say that the age of electricity is already here. A large reason why we've seen such success with renewables over the past decade is that clean power is now cheaper than ever to deploy. After seeing a temporary high in 2022 as a result of supply chain issues and inflationary pressures, we saw that the prices for key clean technologies such as solar, batteries, and wind turbines resumed their long-term downward trend. And they actually reached their lowest quarter ever recorded in 2024. We think this really is a function of two developments. The first is very fierce competition on the manufacturing side, particularly for solar and batteries originating in China, but also a reduction, especially more recently, in key material prices. So a good example of this, of course, would be batteries. Competition, particularly out of China, has really brought down the price of batteries since 2015. But the price declines that we saw in recent years for batteries have largely been enabled by a reduction in the prices for key materials such as lithium, but other critical minerals as well. On the other hand, returning back to the topic of grids, we see price pressures moving in the wrong direction for grids. So oftentimes when people cite problems with grids, it has a lot to do with permitting or regulations. We here in our team, we released a special report that focused on the issue of supply chains for grid equipment. And as part of that study, we issued a survey to numerous TSOs, DSOs, and utilities to get a sense of how the prices for certain equipment have changed over time. And the results of that survey were quite striking for us, because what it yielded is that cables, or the prices for cables and power transformers, have actually nearly doubled since 2018. And this is really just compounding this sort of multifaceted problem of grids. These price signals now, we think, are beginning to flow through to manufacturers. We're seeing investments being made. So hopefully in the medium term, we might expect these prices to come down. But for now, this remains a critical issue. And looking beyond grids as well, too, we're also seeing price pressures in other parts of the energy system. That includes, for example, in upstream oil and gas extraction as a result of steel tariffs, for example. And some of you on this call must have heard about some of the more recent price pressures for natural gas turbines as a result of a pretty incredible increase in demand for data centers. Moving on to the next slide. So returning back to coal. While it is true that investment in coal-fired generation has remained relatively flat since 2015, it sort of skips over an important nuance, or some important developments that have taken place between those years. What we've actually found in 2024 is that we saw the highest number of new FIDs for coal-fired power plants since the year 2015, at over 100 gigawatts. And over 90 gigawatts, so the overwhelming majority of this is being driven by new FIDs in China. To some extent, India as well, too. India had quite a large year, I think 13 gigawatts. That's also the highest it saw in over a decade. But really, we think what we're seeing here is coal capturing a security premium. There is increased uncertainty with oil and natural gas supply chains, and especially in China, against the backdrop of a very high renewable penetration rate. Many countries are, especially in developing economies, are still turning towards coal as a secure fuel source to maintain system reliability. An important caveat for this data is that we don't yet know what the emissions implications of this new coal-fired capacity will be. China has been making a dedicated effort, has invested quite considerably in changing the role of its existing coal power plant fleet into more so providing dispatch services rather than providing baseload power. So at this point in time, we don't know what the consequences will be in terms of emissions. Hopefully, that utilization rate will come down. We did see some important news come out, I think, just a few months ago, that coal emissions in China actually came down in Q1 of 2025. So this is an important area to watch. But from an investment perspective, the point remains that we are expecting investment in both coal supply as well as investment in coal-fired generation to increase in 2025. So with that, I'm going to hand over to Haneul, who's going to stick to the theme of electrification, but looking at the demand side.
Great. Thanks, James. Hi, my name is Haneul. In the world energy investment, I worked on the end use chapter, especially on buildings and also on the finance side. But sticking to this theme of age of electricity, now I'd like to turn your focus a little bit on the demand side of investment and how we as the end users of this power investment that we've been seeing earlier, whether our system is ready to make those changes to this age of electricity and how it's being constructed right now. So if you take a look at demand side investment in the past 10 years, you can see this decade of growth in the sector level. You could see from 2015 to 2025, we estimate that there has been almost a doubling of growth since 2015 to what we see in 2025. And this is a very good sign because energy efficiency efficiency and also demand side investment is not only important for in terms of the climate implications there, but it's also important in the side of energy security, of having reliable services. And so this increase in development over the past decade is something that is very commendable. But as you can see, this momentum is uneven. It's focused on, as you can see there, in buildings and transport. There has been a very marginal growth in industry. And this growth in transport has been mainly pushed by EVs, which I'll talk about in the later slide. Also, buildings efficiency measures as well, such as building codes and a lot of policy measures that have especially been prominent in Europe. And speaking of Europe and speaking of the regional trends, here is, if you look at the same graph just earlier, but in terms of the regional splits. And as you can see, the momentum here is also uneven. You can see that 2/3 of the demand side investment globally has been focused on 3 regions, Europe, United States, and China. And the rest of the world, many of which this rest of the world includes emerging market and developing economies, where most of the electricity demand is going to come from for the next couple of decades. You can see that there is a lot of investment that is lacking in this side, and there has to be a lot of effort to try to mend this imbalance of investment. So going a little bit focusing on the sector level. So I'm going to talk first about buildings and how the energy efficiency investment over the past decade in buildings efficiency and also electrification have changed. So if you look at the overall investment in buildings, they have increased for the past decade. Especially because of the installation of efficient appliances such as residential cooling units. Notably in China, as you can see, there has been a growth there. But if you look at the efficiency side, how efficiently buildings are being constructed or being renovated, such as retrofits or envelopes that make buildings much more efficient in their energy usage, you can see that this share is going to decrease over in 2025 and possibly even longer due to a lot of economic pressures that is going on right now. But however, as I said, despite this share of energy efficiency decreasing, electrification still is increasing. And as you can see, total energy investment in the building sector overall is set to increase marginally, even despite all the macroeconomic pressures in 2025. And so electrification really stands out as an important sector of investment in the building side. One more to add on buildings and electrification, a very big issue that has, and also a sector technology that has been driving buildings growth is the investment in heat pumps. And especially if you can see the chart there, and we tracked this from 2019 and 2024, there has been a remarkable growth in heat pump sales since 2019 to up to 2022, which was a record high. But as you can see, there has been a 2-year consecutive fall in sales. And in the case of 2024, according to the European Heat Pump Association, there was a record decrease of sales in the first half of 2024. And as you can see, this decrease in growth is quite common in Europe. And for this, we can look at this on the right side that I just showed you here, how attractive heat pumps will be compared to the current power prices. So if you can take a look at the figure on the right, you can see that there is a growth of the sales in heat pumps, especially in European countries, over the years where electricity relative to gas prices is cheaper. So you can see at these periods where electricity prices are more attractive compared to what we would usually use gas boilers, for example, there is an increase of heat pump sales because of how attractive and efficient these options are. However, since 2022, due to the increase, the decrease of prices in natural gas, especially, you can see that the heat pump sales have been decreasing. And so this really relative prices of electricity and power is very important in order to encourage the uptake of energy efficient technologies. And for this, there has to not only be market incentives, but also policy incentives that make it very attractive for heat pump intake. And as well as prices in terms of heat pumps, policy support has been very prominent in Europe to try to increase the uptake of these efficient appliances. But the issue is that a lot of these buildings efficiency measures and a lot of policies have been phasing out in 2024 and 2025, which has led to a slight decrease in the amount of energy efficiency investments within Europe. So this is a prominent trend that we think that should be kept track in the building side. One thing to note in the end use sector is also electrification of vehicles and transport. So in clean transport at the IEA, we look at several things. One is electric vehicles, and one is also clean rail. But in this case, if you see the clean transport investment, much of this is really driven by the sale of electric vehicles. And this pace of electrification globally has really been picking up, especially in China. That really takes up most of the sales of EVs, followed by Europe and North America. And if you see that really steep growth in the past decade, from 2018 on and to 2025, 1 in 5 vehicles right now are being sold as EVs. But however, although this investment is very commendable and there has been a lot of growth in clean transport, there is still a lot of support relative that is going into fossil fuels. So if you take a look on the right, you can see the amount that is being invested in electrification in emerging market and developing economies. And if you take that relative to the average amount of oil subsidies that is going into the industry, you can see that there is still a lot lacking in electrification side, especially for EMDE. So although China, Europe, and a lot of these advanced economies are excelling in the pace of electrification and transport, there is still a huge regional imbalance that could really thwart the entire progress of electrification and demand side investment globally. So with that, I'm going to slightly switch gears in the theme of electrification, but to look at what of the largest spenders of R&D are doing globally. And why this is important is because what these companies are investing in is a very good indicator of where the strategic focuses of energy and also electricity is going in the future. And so if you look at this 2015, this is a list of the top 20 companies by R&D spending global in energy-related sectors globally. And as you can see here, it was dominated by these automobile companies. And you can see there's 2 in industry, but only 2 that is focused in terms of electrification. So although there was some representation, it wasn't a very prominent sector in 2015. Fast forward to 2024, last year, you can see that a lot of these companies have changed to energy electrification and also a lot of these new demand side investment. So if you take a look at the automobile companies that was dominated by ICEs, right now in 2024, there has been new EV companies that I'm sure you're aware of that have entered into this top 20 companies in R&D spending. And if you look at the automobile industry, once again, a lot of these traditional ICE companies have also shifted towards producing EVs. And so you can see there has been a lot of emphasis, even in the industry, towards having electrification. And there has been changes in the industry sector as well. If you remember from previously in 2015, there were no companies in the industry side that were focusing on electrification, but this has shifted over the past 10 years. And so as you can see, there has been a very remarkable change in the past 10 years, especially in EVs, as well as battery production, which shows that this age of electrification is no longer a myth, but it is indeed happening. And there has to be more investments geared towards this to make sure that we, as an energy system, is ready to accommodate these new changes. And so with that, I will pass it on to Lorenzo to explain a little bit about the Europe's focus of the clean energy investment.
Yeah. Starting from here, we would like also to deep dive a bit into the European context. We have already highlighted how Europe is leading on clean energy investment, and you can see here some economic and financial indicators, as well as some energy investment indicators. Apart from the fact that Europe is covering its share of GDP over the total GDP of the world is 17%, it's quite interesting to see how clean energy investment are really shaping the European context. Europe is now covering the 18% of the total clean energy investment. And according to the different scenarios, we can see that Europe will reach in 2035 under step scenarios almost 100% of energy investment in clean energy. Taking a better look to the energy investment trends, we can see that under the step scenarios, energy investment surpass $450 billion, with specifically increasing spending on grids and storage and end-use technologies. These 2 classes specifically will increase by 30% in the next 10 years. Then I will leave again the word to James to deep dive it into.
Great. Yes, we're doing a bit of a round of the table. Great. So as part of the World Energy Investment Report, we have a dedicated section that looks at the financial landscape. I have been working with Haneul on our sources of finance model, and this is really about tracking who is investing and financing the energy system over the past 10 years and how exactly are they doing that. And so on this slide here, I wanted to just highlight some of the outputs from our sources of finance analysis with a focus on advanced Europe, so the EU, the UK, some of the Nordics, etc. But really, our sources of finance model, it tracks the instruments, in particular, whether energy investments are being financed with debt or equity. We track who is providing the finance, whether it's coming from commercial sources or whether it's coming from public sources. And we also track who is making these investments into the energy system, including corporations, state-owned enterprises, and households. So overall, if we just start from the top, if we're looking at all energy investment, you can see that the debt to equity split has remained broadly constant over the past decade, about a 50-50 split. I'll return back to this in just a moment. What's changed on the finance side? We've seen a pretty considerable increase in the amount of commercial finance going into the energy system since 2015. But also a pretty remarkable increase in public financial support as well too. And so this would include, for example, direct subsidies to incentivize renewable energy deployment. This would also include spending by, or rather, publicly owned or state-owned equity shares and SOEs who are investing heavily in grids, and so on. And then if we look at the third part of this chart, at the investors themselves, again, corporates are investing much more in the energy system. The SOE share has remained mostly constant, maybe a small uptick, but really quite an interesting story, as Haneul was alluding to in her presentation, is that households have emerged really as a key driver of new investments into the energy system. And I think this whole story becomes a little bit clearer if we just focus on clean energy finance in particular. So on the instrument side for clean energy finance, oftentimes, especially for sectors like renewables, which are very capital intensive, they rely heavily on debt. And so what we're anticipating, or what we're actually seeing take place over time, is because we're seeing a growing share of clean energy sectors in the total investment picture, which rely more heavily on debt, that debt to equity split is actually increasing in favor of debt. And what you're looking at here on this slide, it also includes sort of end-use sectors like electric vehicles or solar home systems, which are financed primarily with equity a lot of the time. But if we were to focus in on sectors like solar and wind, that debt share is really much higher. Moving on to the financiers. So what we can see is actually both on the commercial side, but also especially on the public domestic side, this increase in finance is really been driven by the increase in clean energy. And when we talk about this big increase in public support into the energy system, it really is concentrated for clean energy sectors. And indeed, same thing for the sponsors. I mentioned this story, this quite remarkable evolution of households as becoming a major driver in energy investments today. That is almost entirely concentrated in clean energy, including solar home systems, batteries for households and small businesses, electric vehicles, and so on. And I will pass over to Haneul for the final slides of our roundtable.
Great, thank you. So one last thing that we'd like to discuss about Europe specifically is about the current status of green debt within the European market, as well as energy investment in general. So James just talked to you about where energy investments are coming from, who's making those decisions. Now I would like to talk a little bit about the instruments that are available. So if you take a look at the left there, you can see that sustainable debt has increased just by looking at it remarkably over the past decade. So actually, in fact, this has been over a 20-fold growth from 2015 to 2024. If you look at it on a global scale, a lot of these sustainable debt instruments have been really developing over the past decade, especially so in Europe. So if you take a look at the issuances in 2024, you can see that Europe has taken over 60% of the sustainable debt issuance in 2024, really leading the world market. And also although there has been a lot of concern over the resilience of these financial instruments, you can see that Europe has really held through within 2024. And also in 2025, we as at the part of when we were writing this report, we had data up to Q1, and you can still see there is a very prominent role that Europe was playing back then. And if you take a look here, you can see that Europe right now is very prominently being represented in 2024, and about 60% of Europe's financial of sustainable debt was focused on green debt, and also for China, this was 70%. As you can see, there has been, as I mentioned previously in the presentation, that there needs to be a lot of policy support as well as market incentives. Having these financial instruments that are focused on sustainability, especially in green debt, is important to encourage clean energy investment. And having this kind of instruments available in Europe is a very strong driver for a lot of manufacturers, of producers, of project developers to get into clean energy projects. And also, if you look at, not in the slide, but also if you take an instance about big asset managers and banks, for example, if you look at the Net Zero Bank Alliance, which is a network of banks that is being managed by GFANZ, you can see that Europe has the most largest representation there in terms of membership as well as size, and really has held through despite the series of leaving of the Net Zero Banking Alliance early in 2024 and 2025. And so Europe really still features as a very prominent market when it comes to green debt as well as sustainable debt. And with this, we're going to end this presentation. But as Tanguy has mentioned in the very beginning of our presentation, our report has a lot of more chapters that is dedicated to energy trends globally, as well as more sector-specific analysis. So please do look at the full report for more specific information. And with that, I will pass it over to back to the Energy Club for the Q&A. Thank you.
Okay, well, thank you very much for a very complete and very interesting presentation. I think we have some questions in the chat, so Anna will be addressing them to you.
Thank you very much for all of you. I must say I'm a good fan of this publication because it gives a very realistic view of what is going on in the sector. I'm trying to group the question for you. The first two are related to climate change goals. And the first say, are the investment flows on track to deliver on the renewables and efficiency goals agreed at COP28? Are we going in the right direction? And the second is, in which areas is the IEA more worried about being short in investment, and why? I don't know who wants to address the question, maybe Tanguy, yes?
Yes, I can start. It's a very good question.
Yeah.
As you might have seen from this report, this year, traditionally, we do benchmark the investment against our scenarios, which usually take into account the climate objectives. And this year, we've decided not to do this because we usually elaborate the scenarios in October of the previous year. And we felt like this year, the geopolitical landscape had evolved quite a lot between October and now, basically, when the time where we published this report. So what we decided to do was to just provide the investment picture this year, and we're gonna look at this in the World Energy Outlook, which is coming up in the fall. And so that's the general idea of why we didn't sort of publish those usual benchmarks. What we can say, and I'm just going to give a quick overview, but then I'm going to let James and Haneul maybe speak both on their areas of expertise, where we're seeing, the sort of the tripling of installed renewables and the doubling of energy efficiency goals that were agreed at COP are still out of reach. We still don't see enough investment to reach those, but we're getting a tiny bit closer, very, very marginally a tiny bit closer. And I don't know, maybe I can leave James and Haneul to maybe highlight a few areas or sectors where you see that investment is really lagging behind in both power and demand. I don't know, James, starting with you maybe.
Sure. Yeah, I can start. Yeah, I think I agree with everything Tanguy said. If we were to look at renewables, grids, and batteries respectively, yes, we're off track. We've gotten marginally closer. Where we've probably gotten the closest is batteries. Batteries has been doing quite phenomenally, especially in recent years. So that remains the closest to being on track, for example. But for renewables and grids, we're seeing China have quite impressive growth. They are quite close to being on track as well too, for both renewables and for grids. I guess unsurprisingly, the part of the world where we are the most off track is in emerging market and developing economies, where that investment gap is just continuing to grow year after year. And this is really what's driving it in the power sector. Of course, advanced economies have some way to go as well too. Let's not leave them off the hook. But really, our biggest concern is looking at developing economies, for the power sector at least.
And grids, I guess, if we were to where grids is really, as you said in the presentation, is really the one sort of thing that we really need to pay attention to in achieving those objectives.
Well, on the end use side, definitely there is the buildings that there is a very big concern for. When in the figure that I showed you, buildings and transport is already a very big chunk of demand side investment today. But buildings really need to grow significantly in order to meet these COP28 goals that we agreed upon. And especially echoing what James said on the emerging market and developing economy side, buildings investment is really lacking. And the same goes for transport as well. Industry is a very small part of the demand investment in general. So if we think about if we're on track, that would be the closest, because the amount of growth that needs to come from that sector is the smallest. But also, if you consider buildings and transport, there is a lot of investment that is needed. But in terms of transport, as I showed you, advanced economies and also China is really pushing towards that investment. Whereas this growth and investment that we need to meet these goals really need to come from EMDE, especially on the demand side.
Thank you very much. Security, another issue of concern. I think you have talked about how energy security worries are affecting the energy investment in your presentation. There is a question concerning it. Do you see that policies supporting the home production investment are having any effect, in particular in European Union? And there is another question about critical minerals. During the last years, there has been a growing concern about the high supply concentration for critical minerals, that it led to growth in exploration investment outside the traditional producers. Who is volunteering for this too?
Maybe I can start, and my colleagues can add on this idea of if I rephrase the question a little bit, the energy security concern indeed has shed the light on the importance of mostly like imports and dependency on imports, mainly on the fossil fuel side. You've seen like countries in Asia, for instance, being very dependent on gas import and usually not entering into a long-term contract, and so they're really sensitive to the price of those imports. And so I think going back to the slide that Lorenzo showed, what we see is that there's another slide that we don't, but what we really see is that those countries that are relying the most on fossil fuel imports, those who are net importers, are the ones that are investing the most in the development of clean energy. So sometimes at the IEA we hear, that sort of thing that if you want energy security, you have to invest in fossil fuels. what we see on the ground is a bit different, actually. It's really like we see that those who are highly dependent on fossil fuel imports will invest more on clean energy deployment. So that's quite interesting. On this idea of sort of reshoring the production, that's a bit of a feature of the electrification of the economy and the edge of electricity that James mentioned. You tend to produce your electricity more locally, and so we see some of that. I don't think we are seeing a lot of of new exploration of oil and gas domestically, and because usually this process has been done in the past, and they're not being reopened. But we definitely see a reshoring of electricity production, and also an attempt, and that's a bit a big issue of the time, of like trying to develop the industries of tomorrow and to gain some industrial competitiveness and leadership in those clean energy technologies, with, of course, the realization that China is so much advanced in that space, like and the cost of the technology equipments that have been able to be brought down quite significantly, notably on the solar side and batteries. And so we're seeing some of that, but it's nascent, I would say. On the second question on critical minerals, so that's an area that's of course very important. If you've seen the report, it's something that is not necessarily accounted in our investment numbers, in our total investment numbers, because we tend to focus really on the capex invested in assets, if you will, that will produce energy or manage energy demand directly. And so it's true that we don't today really account them in those investment numbers. However, we do recognize that it's a really important element of energy security. Actually, it's really if you have this translation into a more electrified economy and an energy system that is based on increasingly on renewables and batteries, then you need to have this supply of critical minerals secured. And what we see today is, again, a story of a very high concentration of critical minerals production in China. I forgot the exact numbers, but I think we're over 90% of production of critical minerals in China, and that's obviously a really sort of a vulnerability of the energy system, and we need to see more investment into trying to diversify that production and that supply of critical minerals. I don't know if you want to add.
Maybe just that in chapter 7, in the regional deep dive, for example, in Latin America section and Southeast Asia section, critical mineral investment seen as upfront investment, so capex for mining facilities only, have been taken into account. For example, there is a specific slide related to $45 billion going in upfront investment in Latin America, with a bit of deep dive also at the country level.
Thank you. There is quite a lot of questions regarding electricity. I'm trying to group them. Some are more specific, and there is one general. Starting with the specific point, someone is asking concerning heat pump penetration rates. How have they evolved in recent years for new homes in European countries with higher temperatures, like in Spain or Italy? So that is the first question about heat pump. Second, someone is curious about if you see an increase in repowering wind farm investment. And also a third question, the reason why the price of wind turbines is going up in Europe when in China is going down so much. These are the three specific questions regarding heat pumps, the repowering wind farms, and then the wind turbines again. And there is one general that is, well, in the study you show that investment in grids have been more modest than those for generation. What are the reasons? How to address this imbalance? and what are the implications for the electricity security? I think you touched that point a little bit, but yeah, you want to address this group of questions?
Yeah, perfect. So I think, Haneul, I will let you answer the heat pumps,
Sure.
and then James for all the generation related questions.
Sure. Yeah, I can start with heat pumps. So if you look at, well, I'll say in the terms of sales rather than penetration. So if you look at sales in heat pumps, as I showed you in the figure earlier, there's a huge increase and then there was a decrease. If you look at specifically in Spain or Italy, for instance, it's true that it's the sales of heat pumps is much lower than what you would see in, for instance, Norway or Finland. But there has definitely been initiatives within these countries as well to increase the heat pump uptake, especially if you take a look at Italy. Although it's not for new builds, part of the whole super bonus scheme included something, grants for heat pumps. Also, if I'm not mistaken, there has been initiatives within Spain to increase heat pump uptake within new builds as well as renovation of houses. But in general, even in these hot climates, we often say that heat pumps have a bit of a PR issue because it also serves as cooling, but yet a lot of this whole image issue when it comes to heat pumps sounds like it's only focused on heating. So you definitely see that there's a bit of an issue there, but there has been initiatives previously that have really encouraged the growth all over Europe in terms of heat pump uptake. But this fall of growth, also in Spain and Italy last year, in 2023 as well as 2024, this was an instance in all across Europe, which was a combination of factors, not only because of certain climates, but because of the whole initiatives really phasing out and of natural gas prices, as I mentioned earlier. I hope that's a sufficient answer. And James.
Great. So the question on wind, has investment increased and why do we see a divergence across regions? So as I said, when I spoke to the generation investment slides, over the past decade, yes, of course, there's been quite impressive growth in wind investment of about 70% at the global level. In 2025, we are expecting investment still to increase. That is true. But if you dig into the actual capacity additions being added, there we're seeing a bit of a plateauing. Okay. So we are seeing an increase in spending in 2025, but that's most likely going to be driven by the price side as opposed to capacity addition growth. So why is that the case? From what I've read, when it comes to some of the European manufacturers, they were sort of caught off guard or caught by surprise by the supply chain and inflationary crisis in 2022, 2023. They perhaps had an order book of not very profitable orders that they needed to execute for much lower prices. And so what we're seeing now is a bit of a correction take place, where although these price pressures on the supply side have subsided, they're maintaining slightly higher prices in order to recover profits from some of the hits that they took in previous years. We've also been seeing in some major markets like Germany, the average wind farm size has been coming down. And as a result of that, the economies of scale are actually a bit reduced too. And so that is pushing up the costs in some countries too. And then on the other side of the spectrum, or other side of the world rather, what's happening in China? We have a figure on this which compares manufacturers selling prices for wind turbines in Europe versus China and world energy investment. That's in the power chapter if anyone wants to take a look. But yes, we've seen quite a considerable divergence. I think it begins in 2022. If I were to point to reasons as to why they're able to achieve these cost reductions, it would be probably the same reasons why they're able to achieve cost reductions in most sectors. They have incredibly robust and vertically integrated supply chains. They have this ecosystem which the West just does not have at this present moment. That being said, the financials of these Chinese companies are not in the best shape. They are trying to expand their market share. But to be seen for how much longer they can keep prices suppressed at this level. It's not a very favorable environment for them to operate in. So that's on wind. On the question of grids, why are we seeing this divergence take place? How can it be addressed? As to why the divergence is taking place, I think it varies by country. As I said, a lot of times permitting and regulatory issues are often frequently cited. We spoke to a stakeholder within Spain who was talking to us about grids and the underlying reasons why there was a lack of grid investment in Spain. And what they told us was that it came down to really a sort of lack of flexibility in terms of the planification of new grids. But also in terms of just the amount that they can invest and when. It's my understanding that perhaps there's a cap in terms of how much can be invested in Spain each year. There is a need to front load a lot of this investment, and so perhaps some more flexibility in some jurisdictions makes sense. If you look to other parts of the world, such as the United States, there's just lots of inefficiencies in terms of the permitting system. We're used to a world where the connection queue would be quite small, massive CCGT power plants coming online. That current system is just incompatible with a much more modular and decentralized power system. And the rules that were set up made it so that a developer could throw in applications for many different projects under the anticipation that not a lot of them would actually go through. Theirs came with zero cost for that. And so we're seeing some changes take place in areas such as the United States or the UK, where they're much more strict in terms of if you're putting in an application to connect. They want to really enforce penalties if you don't follow through with that. And I think they're trialing a model. I think it's in the United States. It's called like a first ready, first serve, right? So it's not about when you put in the connection application, it's about when the project itself is ready. So these simple fixes to processes, I think is really key to the solution, but also investigating the timing and some of the flexibility of the investments that we need to make in order to ensure that the transition to the power system can take place at the pace that's required.
Just to a quick word to add on this, we also explored the issue of the supply chain of grids, both in terms of components that are of which the price has grown up. Like if you look at transformers and cables, as we discussed in the slide, but also the production capacity, which is it takes a while to ramp up, and it's being ramped up as we speak, but it will take a couple of years. And also the workforce, they're all also sort of bottlenecks on better grids deployment. And if you're interested in that particular topic, we did release a report in February this year, in 2025, to explore like the supply chains issue of grids.
Thank you. We pass now to question on different regions. In particular, there is one for USA, say like this. During the last 10 years, investment on renewables and low emission fuels in the United States almost double. With the new government and less supportive policies, how do you think could the investment in this area evolve in the country? That is the first. Then about China, why the investment in coal is still growing and what are the implications? And is there any area in which China is not the number one in investment? For Africa, you show some worrying indicator, no? That investment in the region are decreasing. Could you give us some insight on this issue? Who has been the traditional investor in the regions, and how to mobilize capital there? Yeah.
I would also like to add concerning regions, a question on hydrogen, which is which regions are investing most in hydrogen and in which hydrogen technologies?
Thank you.
Okay, so maybe I can take the one on the US on hydrogen. I'll group those two, and I can leave James to answer the coal question and to answer the Africa question. That works this way. Perfect.
Perfect. Thank you for organizing yourself.
On the policy developments in the US, so there's maybe we can separate also there in by sectors. The US is obviously very interesting, and the short answer is that we actually don't really know what's going to happen and the extent to which the policy developments will influence investment there. Because we've seen initial cancellations of projects, but then they restarted. So it's very difficult to project in the long run. What we see is that there is in many places the business case for clean energy is there, and so regardless of policies, some technologies have reached a sort of a mature enough stage that they will probably move forward. Maybe not to the same extent that we were initially seeing, but we don't see a complete stop in clean energy deployment in the US because of the policies, and some sectors also are included in the policies that we consider clean. For instance, if you look at the nuclear energy, the current administration has made clear that they were in favor of that technology, and to us it is a reliable source of clean power. So we see that. If you look on the oil front, the sort of the oil and gas front is very interesting, because there you can really see that what's shaping the investment in new projects or in expanding projects is really the outlook for the oil demand and the price of oil, and that regardless of what the policy might do, it's really like whether the price of oil reaches a certain level that will trigger new investments. And so we're monitoring that quite closely. And actually that speaks also to hydrogen. On hydrogen, we've tried to make an assessment. On hydrogen, there's a little bit of a concern, because we've seen projects that had reached FIDs. I think it's 3 big projects last year that had reached FIDs and that have been cancelled in the end. And so the outlook is very, very dependent on the future expected demand, and that remains quite uncertain today. And so we're seeing projects that sometimes struggle to move forward because of this sort of uncertainty around the future demand from hydrogen, which stems from many different developments. But in our case, for instance, we saw that some technologies that we were anticipating to be powered by hydrogen, namely, for instance, long-haul freight, long-haul trucking. It seems like now those energy needs will be catered by electricity, by batteries, and so that sort of took off some of the anticipated demand for hydrogen. And so that's an area we're looking at. We don't have a definitive answer yet, but as in for many other sectors, and you can think of biofuels, SAFs, it's really like the anticipation of future demand that will drive the investment. And if there's uncertainty around it, you're going to start to see like project cancellations and things like this. So it's really a matter of making sure there is the demand for those products. James, now again, let's you to coal in China.
Yeah. So why is investment in coal, or Chinese investment in coal, still growing? So multiple factors. Of course, we're looking at considerable economic growth, also very fast increases in electricity demand. We also have increasing uncertainty or variability in the output of hydropower. That's part of the answer. There's a lot of risks and uncertainties, especially recently in terms of gas and LNG supply chains. And then, of course, there's an abundance of domestic supply of coal in China. And so I think the energy security angle is really important in explaining recent investment. But as I said before, and I would encourage you to read our coal market report, which goes into this, goes into a lot of these points in a lot more depth than I did in World Energy Investment. But also this very high solar and wind penetration rate is quite an important factor as well too. the Chinese government, I think, is partially trying to transform the role of coal to provide flexibility and just to balance an increasingly variable generation mix. And so we could see the utilization rate come down for these coal-fired power plants as they're used to just balance the system more so than provide baseload power. So as I said, we don't yet know what the implications of this are, especially from an emissions perspective. We're certainly watching this area quite closely. In Africa.
Yeah, and to answer to the Africa question related to the decrease in investment, broadly speaking, this is a product of a large fall in spending on oil and gas that is only partially compensated by the increase in renewable spending. Then, taking a deeper look, we could highlight that public and DFI funding for energy products in Africa have been strongly fallen, also because there was a 85% decline between 2015 and 2021 of Chinese DFIs. Moreover, after this decline, there was also some spikes after 2021, but country-specific, for example, in Mozambique, Namibia, Mauritania, and Senegal. Just to highlight that this is one of the reasons why IEA is working with different African countries on investment frameworks to try to mobilize more capital, both domestic and international capital. I hope I answered to the question.
Just to add to this, one thing that we're really looking at is this cost of capital that is much higher in Africa, or at least the risk perception of investing in clean energy projects or in any energy projects in Africa is perceived as much higher. Sometimes it's not always justified by the data you see and by the project failure data. And so we're trying to first gather data on the cost of capital in around the world, but especially in Africa, and how to address this issue of having a higher perceived risk profile in Africa than it is, and so trying to find ways eventually to lower that cost of capital, so that Africa can sort of compete for capital in a better place than it is today.
Thank you. There is one last question, if you have couple of minutes more, and it's about innovators. How energy innovators are evolving, how are they adjusting to higher cost of capital and policy uncertainty? Maybe it's for Jano, since in her intervention touch the R&D part. I don't know if you want to say something about that, Jano?
Do you want to say something about? I think because you presented the R&D slide.
Sorry, I missed the last part of the question. Sorry.
So I think this issue of the cost of capital is actually it's interesting, because we see higher cost of capital in Africa, but in other parts of the world the cost of capital has actually been kept relatively in check, and it's not since the inflation of after COVID, it hasn't gone up significantly. So there's still money being available for innovation. What we're seeing and what we try to, if you look at the long-term trend, we have a lot of new R&D and venture capital funding going into innovation in the electricity sector, in the batteries, in the development of batteries, of EVs, and things like this. If you look more at what's happening in the very recent years, like last year and this year, we do see a sort of shift of venture capital and R&D towards things that are less maybe energy related, that look less energy related, like the things going. We've seen, for instance, a sort of translation of funds going from climate tech to AI tech to things like this. To us, it's still energy, still very much very important to address. But this is maybe the response you will see in terms of early stage innovation funding. You will see sort of this shift. That being said, we still see a healthy level of public R&D and corporate R&D into new energy technologies that will shape the future innovation of tomorrow. But I'd say here the story is really there really two sides. There are those technologies that we know that they're in a sufficiently advanced stage of development. They still receive funding, like if you think of batteries, and there are the others that still need quite risky funding and quite risky innovation. And those the outlook is more in certain. Hydrogen is one example. But there's also all those areas around the sustainable fuels and things like this. Where the outlook is a bit uncertain, you see the corresponding sort of reducing in investment and in venture capital and R&D investment that are conducive to innovations.
Thank you very much. It's all from my side. There is no more question. I give the floor back to Pablo. Thank you very much again.
Okay, well, I think we're going to finish it here. Tanguy, Lorenzo, James, Haneul, thank you very much for your presentation. Thank you and congratulations for the document and for also receiving all these questions and knowing the answer for most of them, which is not an easy task. And we hope to see you again soon for another investment report here in the Spanish Energy Club. Thank you very much, and thank you everyone who has been connected and who has come here for the presentation. Thanks very much.
Thank you.
Thank you.
Bye-bye.
Bye-bye.
Bye.